Today, we are going to tackle a question that many of you have probably asked yourselves. You have $100,000 ready to invest, you have done your homework, you have decided that index funds are the way to go. Smart move. But now you face a big decision. Do you go with Fidelity or do you go with Vanguard? Two giants in the investment world. Both offer excellent options, but which one will actually make your money grow more over time? The answer is not as simple as you might think, and it could make a huge difference in your financial future. So stick around, because by the end of this video, you will have a much clearer picture of where to put your hard-earned money. Before we dive into the big comparison, let's quickly recap what an index fund is. An index fund is a type of mutual fund or exchange-traded fund, an ETF, that holds a portfolio of stocks or bonds designed to mimic the performance of a specific market index. Think of the S&P 500, for example. An S&P 500 index fund would hold all 500 stocks in that index, in the same proportions as the index itself. The beauty of index funds is their simplicity and low cost. Instead of paying a fund manager to actively pick and choose stocks, you are passively tracking the market. This means lower fees and, historically, better returns than most actively managed funds. Now let's meet our two contenders. In one corner, we have Fidelity, a powerhouse in the financial industry, and we will be looking at one of their most popular offerings, the Fidelity Zero Total Market Index Fund, with the ticker symbol FZROX. In the other corner, we have Vanguard, the company that pioneered the index fund and is beloved by passive investors everywhere. We will be examining their flagship fund, the Vanguard Total Stock Market Index Fund Admiral Shares, with the ticker symbol VTSAX. Both of these funds are what we call total stock market index funds. This means they aim to track the entire U.S. stock market, not just a specific segment like the S&P 500. You get exposure to thousands of companies, from the largest corporations to the smallest startups. It is a great way to diversify your investment and capture the growth of the entire U.S. economy. So, where do we start our comparison? Let's talk about the one thing that can eat away at your investment returns over time: fees. This is where Fidelity has made a huge splash in the industry. The zero in FZROX stands for zero expense ratio. That's right, Fidelity charges you nothing to manage this fund. An expense ratio is an annual fee that all funds charge to cover their operating expenses. It is expressed as a percentage of your investment. So, a 1% expense ratio on a $10,000 investment would cost you $100 per year. With FZROX, that cost is zero. This is a massive selling point for Fidelity, and it has attracted a lot of investors. Now, let's look at Vanguard. VTSAX has an expense ratio of 0.04%. That is incredibly low. To put it in perspective, the average expense ratio for actively managed mutual funds is around 0.50% or even higher. So, on a $100,000 investment, VTSAX would cost you just $40 per year. That is a tiny fraction of what you would pay for many other funds, but it is not zero. So, on the surface, Fidelity seems to have the clear advantage here. A zero expense ratio means more of your money stays invested and working for you. Over many years, even a small difference in fees can add up to a significant amount of money. We will come back to this later when we run the numbers on our $100,000 investment. But fees are not the whole story. What about performance? How have these two funds actually done in terms of growing investors' money? As of late 2025, the year-to-date return for FZROX was 14.19%. For VTSAX, it was 13.67%. So, a slight edge to Fidelity in the short term. Looking back over the past year, FZROX returned 15.94%, while VTSAX's return was around 15.78%. Again, very close, but Fidelity is slightly ahead. Over a 5-year period, VTSAX has a slight edge with an average annual return of 15.78% compared to FZROX's 14.22%. It is important to remember that FZROX was only launched in 2018, so we have less historical data to work with compared to VTSAX, which has been around since 1992. This longer track record gives some investors more confidence in Vanguard's fund. Past performance is no guarantee of future results, but it is still a useful tool for comparison. So, why the difference in performance, even though both funds track the total stock market? It comes down to the specific index they follow. VTSAX tracks the CRSP-US Total Market Index, while FZROX tracks the Fidelity US Total Investable Market Index. These indexes are very similar, but they have slightly different methodologies for constructing their portfolios. This can lead to small variations in their holdings and consequently their returns. For example, at the end of 2025, FZROX had about 2,578 holdings, while VTSAX had over 3,700. This difference in the number of stocks can also contribute to the performance gap. Now, you might be wondering, if Fidelity's fund has a zero expense ratio, how do they make money? That is a great question. Fidelity is a for-profit company, so they are not offering these funds out of the goodness of their hearts. There are a few ways they can generate revenue from their zero-fee funds. One way is through securities lending. This is when a fund lends out its shares to other investors like short sellers and charges a fee for it. Fidelity keeps a portion of this revenue. Another way is by cross-selling other products and services. When you open an account with Fidelity to invest in their zero-fee funds, you are more likely to use their other services, like their brokerage platform, retirement accounts, or financial advisory services. Finally, there's the cash that sits in your account. Fidelity can earn interest on the uninvested cash in your brokerage account. So, while you are not paying a direct fee for the fund, Fidelity has other ways to profit from your business. There's also the question of dividend yield. Some analysts have pointed out that Fidelity's zero-fee funds may have slightly lower dividend yields compared to their Vanguard counterparts. This is because of the way they manage the funds and the securities lending we just talked about. The difference is usually very small, but it is something to consider, especially for long-term investors who rely on dividends for income. Let's talk about another important consideration: tax efficiency. Both funds are generally tax efficient because they are index funds with low turnover rates. However, there can be subtle differences. VTSAX has been around longer and has had more time to optimize its tax management strategies. The fund has a turnover rate of around 1%, which means it holds onto stocks for long periods, reducing taxable events. FZROX also has a low turnover rate, but being newer, it has less of a track record in this area. For investors holding these funds in taxable accounts rather than retirement accounts, tax efficiency can make a meaningful difference in after-tax returns over time. Another factor worth considering is the fund company's overall philosophy and approach to investing. Vanguard was founded on the principle of putting investors first. The company is actually owned by its funds, which means it is owned by its investors. This unique structure aligns Vanguard's interests with those of its shareholders. Fidelity, while also investor-focused, is a traditional for-profit company. Both approaches have their merits, but some investors prefer Vanguard's mutual ownership structure because it theoretically eliminates conflicts of interest between the company and its investors. Another important factor to consider is the minimum investment. This is where Fidelity has a big advantage for new investors. FZROX has a minimum investment of $0. You can start investing with just a few dollars if you want. This makes it incredibly accessible for people who are just starting their investment journey. VTSAX, on the other hand, has a minimum investment of $3,000 for its Admiral shares class. This is the most popular share class with a low 0.04% expense ratio. Now, let's get to the main event, the $100,000 showdown. Let's say you invest $100,000 in FZROX and $100,000 in VTSAX. We will assume an average annual return of 10% for both funds, which is a reasonable long-term average for the stock market. We will also factor in the expense ratios, 0% for FZROX and 0.04% for VTSAX. Let's see how your investment would grow over time. After 10 years, your $100,000 in FZROX would grow to approximately $259,374. Your $100,000 in VTSAX, with its 0.04% expense ratio, would grow to approximately $258,339. That is a difference of about $1,035 in favor of Fidelity. Not a huge amount, but it is still over $1,000 more in your pocket. Now let's fast forward to 20 years. Your $100,000 in FZROX would be worth around $672,750. Your $100,000 in VTSAX would be worth about $667,028. The difference has now grown to over $5,700. Again, not a life-changing amount, but it is starting to become more significant. Finally, let's look at a 30-year time horizon. This is where the power of compounding really starts to shine. After 30 years, your $100,000 in FZROX would have grown to a staggering $1,744,940. Your $100,000 in VTSAX would be worth $1,724,486. The difference is now over $20,000. That is a substantial amount of money that you would be leaving on the table by choosing the fund with a slightly higher expense ratio. So, based on these numbers, it seems like Fidelity's FZROX is the clear winner, right? Well, not so fast. There are a few other things to consider. As we mentioned earlier, VTSAX has a much longer track record than FZROX. It has been through multiple market cycles, including the dot-com bubble and the 2008 financial crisis. This gives some investors a sense of security and confidence in the fund's ability to weather any storm. FZROX, on the other hand, has only been around since 2018. It has performed well so far, but it has not been tested in a major market downturn. Another thing to consider is the size of the funds. VTSAX is one of the largest mutual funds in the world, with over $2 trillion in assets under management. FZROX is much smaller, with around $29.5 billion in assets. A larger fund size can offer some advantages, such as economies of scale and greater stability. However, it can also make it more difficult for the fund to maneuver in the market. So, which one is better for you? The answer, as with most things in finance, is it depends. If you are a new investor with a small amount of money to start with, Fidelity's FZROX is an excellent choice. The zero minimum investment and zero expense ratio make it incredibly easy to get started. If you are a more experienced investor with a larger portfolio, the choice is less clear. The slightly higher expense ratio of VTSAX might be a small price to pay for the fund's long track record and the peace of mind that comes with investing in a Vanguard fund. Ultimately, the best fund for you will depend on your individual circumstances, your risk tolerance, and your investment goals. Here is a quick summary to help you decide. Choose Fidelity's FZROX if you are a new investor with a small amount of capital. You want to minimize your investment costs as much as possible, and you are comfortable with a fund that has a shorter track record. Choose Vanguard's VTSAX if you have at least $3,000 to invest. You value a long track record and the stability of a larger fund, and you are willing to pay a very small fee for the potential benefits of investing with Vanguard. No matter which fund you choose, the most important thing is to start investing. The sooner you start, the more time your money has to grow. Both FZROX and VTSAX are excellent choices for long-term investors. They offer broad market diversification, low costs, and the potential for significant growth over time. The difference between the two is relatively small in the grand scheme of things. The most important decision you can make is to start investing in a low-cost, diversified index fund and to stick with it for the long term. And there you have it, a deep dive into the Fidelity versus Vanguard debate. We hope this video has helped you understand the key differences between FZROX and VTSAX and has given you the information you need to make an informed decision. Remember, building wealth is a marathon, not a sprint. The key is to be consistent, patient, and to keep your costs low. If you do that, you'll be well on your way to achieving your financial goals. If you found this video helpful, please give it a thumbs up and subscribe to Frankie Finance for more content like this. We are here to help you navigate the world of personal finance and build a brighter financial future. And do not forget to share this video with a friend who might be struggling with the same investment decision. Let us know in the comments below which fund you are leaning towards, Fidelity or Vanguard. We would love to hear your thoughts. Thanks for watching, and we will see you in the next video.